The Institute for Supply Management on Monday reported that its index of manufacturing activity slipped to 50.9 in September from 52.8 in August. But for the 28th month in a row, it was above 50, the cutoff between manufacturing, contraction, and growth. Likewise, a manufacturing index from the S&P Global showed U.S. activity continued to grow last month. Manufacturers' recovery from the plunge they experienced early in the pandemic has been remarkable. The support many households received from the government, plus the shift in consumer appetites towards goods, provided them with ample demand, and output quickly bounced back. So too did employment. There are now more factory jobs than there were before the downturn, something that has occurred following no recessions since 1970s. However, for the past several weeks, the environment for manufacturers has gone from challenging to awful. The jump in interest rates, which took the average rate on a 30-year fixed mortgage to 6.7% at the end of September, from 5.6% at the end of August, has impacted housing activity, an important source of demand for many factories. Not only will builders be likely ordering fewer materials, there will be fewer people filling up on their newly purchased homes with appliances and other things like that. Meanwhile, the dollar has also shot higher. On a trade-weighted basis, it was 12% higher late last month than a year earlier. While it can take time for exchange rate dynamics to affect activity, the fact is that the dollar's strength is making it harder for US-based manufacturers to compete on price with their overseas counterparts, both at home and abroad. Along with the high dollar strength, we also have other key events happening, the war that we have in Ukraine. Now, there might be some good news to this. For example, there is a strong underlying demand for new cars. And semiconductor shortage is also easing. Now, this is very important because the auto industry and its many suppliers remain the biggest player in US manufacturing. Moreover, supply chain issues have resulted in businesses to explore sourcing goods and materials closer to home. And one key major advantage that US manufacturers have over their European counterparts is that energy is a lot cheaper in the US. Now, on Monday, Credit Suisse shares lost as much as 10% because the bank's executives are in talks with its major investors to reassure them amid rising concerns over the Swiss lender's financial health. Spreads of the bank's credit default swaps, which provides investors with protection against financial risks such as default, rose sharply. The bank said that they will provide updates on a strategy that will be released with its third quarter results. The bank has reported that it is in a process of a strategy review that potentially includes asset sales. Now, a lot of people on Twitter and Reddit are comparing this to the 2008 crisis with the Lehman Brothers, how their downfall happened due to a sharp increase in the credit default swaps. But a lot of them, what I've seen online, a lot of them are saying it's not as bad, it's not going to be the end of the world. The current situation is night and day from 2007, as the balance sheets are fundamentally different in terms of capital and liquidity. Now, while we're talking about the Credit Suisse, we have to talk about analysts have downgraded the S&P 500 forecast, which I thought was very, very interesting. So, I want to add some context here. The S&P 500 has shed around 25.6% from its all-time peak of 4,818.62 in early January. Now, last Friday, it closed at 3,585.62. For the end of 2023, Credit Suisse expects a 13% upside from its current levels and has set a target of 4,050 points. They are predicting that 2023 will be a year of weak non-recession and falling inflation. Now, Citigroup, on the other hand, expects the index to end 2023 at 3,900 points. Moreover, Goldman Sachs last month cut its year-end 2022 target for the S&P 500 about 16 points to 3,600 points, as the US Federal Reserve has shown no signs of stepping back from its aggressive rate hike stance. Next, we have to talk about Michael Burry. Now, anytime we talk about Michael Burry is the dude that shorted the 2008 financial crisis, and he's super active on Twitter and, very often just deletes his tweets. But, I think this is his key moment to shine again, and he has been talking about how US consumer spending is too high, how it's all silly, and we should, he basically thinks we should have had a recession long time ago. But recently he tweeted, and today that's what I want to talk about. On October 1st, Michael Burry tweeted, 13.48% of stocks closed above their 200-day moving average yesterday. Bottom in 2009 was 1.2%. Bottom in 2020 was 2.8%. Currently at 2007 levels. On September 30th, he said that this morning there are still 218 primary stock listings in the United States with a market cap of over 1 billion and an EBITDA less than negative 100 million. Moreover, he said that 29 of them had market caps over 10 billion, totaling 655 billion. He added, furthermore, saying it again, all the silliness must go. Basically, Burry is saying that there are so many companies with inflated valuations. He believes that the performance of these firms does not justify their stock market valuation because they are losing so much money. Therefore, a violent correction is to be expected. Now, he did not give the names of the 218 companies, and EBITDA, which is basically earnings before interest, taxes, depreciation, and amortization, is the mostly watched indicator by investors because it gives an idea of a company's financial health and ability to generate cash. And like I said earlier, Burry is really good at predicting a market crash. And in August, he said that the stock market crash was more a matter of when, not whether. Now, lastly, I just wanted to talk about some data for usual Octobers. Now, like I said again, and like how Michael Burry said, this time year around, it is not like a normal, it's kind of like an exception. There's just so many things going on. The dollar is so high. We have a war going on. There is also the Fed is aggressively increasing rates. So this is definitely not like usual Octobers. But actually, historically, October has been a very positive month for stocks, resulting in an average boost of around 0.9% for the S&P 500 since 1945. So this I thought was very interesting, and today was a very interesting day for stocks. Tesla was down, obviously because of its deliveries and production numbers that it recently released before their earnings. But yeah, overall, it looked like the market was in a green, except for Tesla. But yeah, I hope you enjoyed this video, and I shall see you in the next one. Bye!